All right. Welcome, everyone. I'm here today with Will Vaughan, and we both met at the Berkshire Hathaway meeting where we talked a lot about financial topics. And Will, why don't you introduce yourself a little bit?
How are you, buddy? My name is Will Vaughan. I come from northern New Jersey. Actually, live in Newark right now. I'm from South Orange originally, and this year was my first time going to the Berkshire meeting. I wanted to go out there, as you know, who knows how much longer we have with Uncle Warren and Uncle Charlie. Um, I was out there, met a lot of great people. I met Michelle actually at the TIP event, I believe, the Investors Podcast, and we started talking about our interests and our passion for investing. Then we realized we live very close to each other. Actually, both are in New Jersey. But we talked about a couple of the topics that have been brought up at the annual meeting, particularly this year, but I brought up in past annual meetings as well. When we were talking about what we personally do for a living. So I actually work in wealth management. I'm a financial advisor. And so hearing that, she was surprised. I don't want to speak for Michelle. Surprised, like, oh, so you're a financial advisor. Buffett hates financial advisors.
Well,
So why are you here at the meeting? Yeah,
yeah, he might not be their biggest fan, and it's
yeah,
really echoed on like not everybody should go into wealth management.
yeah, yeah, exactly. And we got to talking about topics and thought it would be interesting to put it into YouTube form. But it's nuances. I think that a lot of the points that Buffett and Munger bring up on financial advisors and wealth management are really valid points. There's a lot of bad folks out in the industry that are just trying to collect assets, and they're not really offering sound financial advice. And it's more of a sales type of job versus an actual advising job. So there's a lot of bad stuff out there in the industry where advisors don't necessarily provide a lot of value. But then there's also another side to it as well. And I think there's a lot of situations where financial advice is useful and adds a lot of value to people's lives. So I just don't think it's a one size fits all thing or super black and white. I think there's a lot of gray area and it's
Yeah,
nuanced. Yeah.
for sure. And speaking of some of that, none of what we're talking about today is for advice. It's just for educational and entertainment purposes. So,
Mhm.
Will is really kind to share a lot of his insights about, kind of how this financial planning kind of works and how that may or may not benefit some people, because a lot of people who might study Warren Buffett and Charlie Munger, they might prefer to invest in certain ways. And there might be people who need a little bit more handholding and some who are more independent. So depending on kind of one's own affinity toward the stock market, and then also separate from stocks, people need all kinds of financial help. So it's not to say that, the area that you work in is only strictly focused on investment management. There's also other aspects, right, that you work with people on.
Yeah, definitely. And it's actually on a day to day, investment management isn't what I focus on at all. Actually, we have at my firm a built out investment team that handles the day to day trading and thinking about the overall strategy. I handle the financial planning side for my clients. So that's everything from retirement planning, so running a financial projection to see when can you retire, how much can you spend in retirement, how much you need to save to get there, how you should invest to get there. And it's also things like income tax planning, things like estate planning, philanthropic giving, health insurance. So there's a ton of things that go under that financial umbrella. And all of those things, add value and need to be coordinated with the investment portfolio to get folks where they need to go. So I think a lot of what Buffett and Munger think about or talk about is the investment management and the wealth management industry, how it has been historically, right? So they've come up through the entire evolution of it, where back in the 60s, 70s, there was no such thing as financial planning. Right? If you hired someone to manage your money, that's exactly what they just manage your money and manage the investments. And their value add was, can I beat the overall market, right? Or can I beat what someone would have done if they were doing it on their own, right? And that's all they focused on. Nowadays, the financial planning space has grown a lot to where, I would say most of the value that I would add as an advisor doesn't even come from the investment. It comes from all those other pieces together coordinated with the investments, right? Because with tax laws changing, with people's lives changing and goals changing. Like, there's so many different factors to it outside of just returns, right? So it's like, can I send my kids to college, right? So if I'm doing that, how do I prioritize saving for college for my kids versus saving for retirement or something else I want to do, right? And so those different things change as different pieces of people's lives change. So it's pretty nuanced.
Yeah, and what do you think about how the way that Buffett and Munger seem to talk about it? It's as if, if you're going to get a financial advisor, it should be pay for performance rather than fee for advice kind of thing. So I, I I'm not sure exactly what they've seen that they're so critical about, but I think that's something that it's interesting that you said in the earlier days, maybe that was more of a part of the incentive system, but it's moved away from necessarily trying to beat the market. So why do you think that that's less of a focus in this day and age?
Well, okay, so I would say it still is the main focus. So I think if most financial advisors you go to, um, the pitch that they're going to give you is about a lot of times performance. And because it's been so ingrained into our thinking, and that was the only thing that was available, a lot of people focus on that when hiring an advisor. It's like, are you going to beat the market, right? And so a lot of the materials and the marketing is based on performance as the main factor. But in the past, I'd probably say 20 to 40 years, really, it started really in the 80s. Financial planning as a discipline has grown a lot because folks realize that investments don't exist in a vacuum. People need to draw on their portfolio. People have different life situations that might make the most attractive thing quantitatively from a numbers perspective, not be the most attractive thing once you consider the qualitative, right? What's going on in the personal life. So it's really important to marry those two things together. I think Buffett and Munger have said it before. It's not about what you make in terms of investments. It's about what you keep. Which you have to think about your after tax return, right? Not your pre tax return. So then that's where tax planning became super important as well. So it's just grown and grown and grown. And where I sit in that field is much more on the financial planning side. And my firm is very financial planning heavy, but there's still a lot of firms out there that are very investment heavy, right? So I think that's something to be wary of. I don't think it makes sense to pay, a higher fee if it's only investment management that your advisor is doing for you, right? I think it really makes sense when they're looking at everything holistically in your life.
Yeah, for sure. And how do you feel personally as an individual investor? Do you tend to gravitate more towards, say, funds where, Warren Buffett totally endorses index funds and thinks that most people should just do that instead of like, some of us who might have more confidence, we might want to try to beat the market, right? Like I know that I'm trying to do that by trying to like cherry pick certain stocks, but I'm
Mhm.
not necessarily more successful than someone who is just an index fund investor. So where do you kind of stand on some of that?
I think it depends on where your passions are and how much time you're going to spend doing it, right? And Buffett's talked about this a lot over the years. It's like if you're a know nothing investor, that's the term he uses. If you're a know nothing investor and you don't really want to spend the time becoming an expert, then you should just invest in the index, right? So S&P, other indices as well, and create a diversified portfolio because that way you're sort of outsourcing your financial decisions to something that has performed relatively well over the long term. Um, but if you're really into the game and you want to become the best at your craft and really hone your skills and you love individual stock picking, then that's something you should focus on. With the caveat that I think that um, a lot of folks have a little bit too much confidence in their personal investing skills, right? And it's really easy to get overconfident based on the returns you've had in the most recent past and think, well, I'm going to continue crushing it. And then you take too much risk because, you get very confident in what you think the ultimate outcome will be. Um, with that being said, on the personal side, I love stocks. I love individual stock picking. So that's always something I'm going to do because I get a lot of enjoyment out of looking at the micro specific companies and will this company do better than other companies in their industry and trying to find those outperformers. But I do that with a portion of my money. I also have a portion that I say, look, I don't want to, risk my long-term financial future. So I'm going to have that a little bit more diversified in index funds and things like that. Like, I don't think that it has to be exactly one way or the other. I think you have a combination of both.
Yeah, yeah. And speaking of risk, I heard you mention risk a few times. Maybe we should talk about what that means, because risk is surprisingly kind of varied in its definition, and a lot of people think of risk in many different ways. And
Mhm.
I know Buffett's official definition is, the ability to lose your capital permanently. So if you, like, that's what he considers risk, from what I know, is like, if you lose your money, like really lose it, not just, when a lot of people say they're losing their money in the stock market, I ask them, have you actually sold? Did you lock in a loss? Because until you sell, that's just a paper loss. It's not locked in. So it's kind of funny how, people talk about losing money, but it's not over until it's over. So kind of
Mhm.
like, how do you see risk, and how would you define it?
Yeah. This is a great topic because I think that so Buffett brings up great points on this, but I also think there's a piece that is more nuanced and could be missing, right? So Buffett and Munger hate the fact that risk a lot of times is defined as volatility, right? And volatility is just how much your investment moves, in a year or over the short term. Not necessarily, well, what is the actually underlying value of the investment, and what's my margin of safety, and where do I think it's going to be 10 years, 15 years, 20 years from now. I agree with Buffett that volatility shouldn't matter as much if you have a long time horizon and you don't really need to sell, right? So if you are investing money and you can wait 10, 15, 20 years, well, why would it matter to you if the investment you like has 50% volatility versus 40%, right? Because you're going to ride out that volatility over the long term to realize that long-term value of where you think this company or this stock, this asset should be valued. Um, Volatility becomes very, very important though when you need to sell. And what are some situations where you might need to sell? Well, will need to sell a portion of your assets in retirement, right? So once you get close to the point where you go from the accumulation phase of building up and adding to your wealth over time to now you're going to the distribution phase where you've built up all the wealth that you're ever going to have. This is your nest egg, and now you need to start pulling from that portfolio, right? So it becomes a withdrawal type of phase. Um, in the phase where you need to withdraw from your assets, volatility really starts to matter because, like let's say for someone like Buffett or Munger, they're so wealthy that their withdrawal rate on their assets on an annual basis is 0.001%. There's something way less than 1%, right? So for them, volatility doesn't really matter. The value of their stock could fluctuate 70, 80%, and they'd still be fine. But for most people, their level of withdrawals for living expenses that they need compared to their overall nest egg is much higher, right? So, rule of thumb in the industry, and this is not a one size fits all, but just a rule of thumb is, folks might have a 4% withdrawal rate on their assets annually, right, when they retire. So if you have $1 million, right, you're drawing 40,000 of it annually for living expenses. Well, if your $1 million has 50% volatility, so it drops 50%, let's say in a year, and goes down to 500,000, well, your living expenses didn't change. You still need to withdraw 40,000 to pay your bills, right? So you went from a 4% withdrawal rate on the million balance to now you're drawing 40,000 on 500,000. Now that it doubled, it's an 8% withdrawal rate. And so volatility can matter when you have withdrawals because if you have to withdraw at a low point in a market, you're forced to sell at a time where maybe your asset is undervalued and your capital base is permanently impaired, right? You can never get that back, even if you have a rebound later on. So in that scenario, like let's say your whole portfolio is Berkshire stock, right? Which some people do, and some people have that portfolio. Well, Berkshire stock, even though it's a great company, has fallen 50% or more in a year or 2 year period, right? And if your withdrawal rate is, let's say, 5 or 6% on those assets, that can really hurt you having to withdraw at that low. So, you can actually help your situation by adding some other things to your overall portfolio to where if you add something that's uncorrelated to the stock market or uncorrelated to Berkshire, when Berkshire's down 50%, you can now draw on this other thing, right? That's held its value. So you can give your Berkshire stock time to recover back to a more reasonable valuation before you start pulling on it again.
Yeah, that makes sense. And yeah, I guess with factoring required minimum distributions or
Mhm.
RMDs that a lot of folks will face on their 401ks and IRAs, that definitely could be pretty challenging. But at least maybe the glass half full way to look at that is a lot of employers have only available funds. So in a way, like for people who might have a lot of their money in a employer sponsored 401k and then they're made to withdraw their 4%, if even if the market's kind of down, everybody is going to kind of experience that similar thing. And by withdrawing
Mhm.
from a fund, it kind of that extra diversification sometimes kind of buffers the blow, as
Yeah.
opposed to 50% volatility in one stock. Maybe a market is just down 20 to 30%, and while that's not great, but it's less bad than maybe if it were just an individual stock. And at that point, maybe people don't want to be, what they call taking as much risk at that point. You know how they say supposedly, you start out when you're younger with a more concentrated portfolio in stocks, and then you move
Mhm.
to safer bonds. And I put bonds in quotes because not all bonds are safe,
Mhm.
like depending on, what you're kind of committing to. So,
Yeah.
but that's just like the common advice of, when you get older, put your money in bonds or whatever. But maybe what people could also do is if they can foresee that they are going to need, to comply with the RMD and take out some amount of money every year, then maybe they gradually reduce and sell some of their assets ahead of time so that
Mhm.
they're not like, I know there's automatic RMD dates. So there's a point at which, like, whatever you own, it will just automatically sell some of what is in there. But maybe you can preempt some of that by selling when you're comfortable and when you think you're getting a good price, so that you kind of earmark some in cash or in maybe a money market fund to kind of sit in there until it's time to, to be made to take it out, perhaps.
Yeah, definitely. And that is where diversification can have a benefit is when you have a cash need that's coming up and in retirement, your cash need comes up annually. Being proactive about making sure you have some type of reserve that's set aside that's less volatile that you can pull from in down periods. And that's the purpose that fixed income has served or bonds have served in portfolios for retirees historically. Now, we can talk about 2022 last year, where that was really the worst year for a diversified portfolio ever because both stocks and bonds were down double digits in the same year. That's extremely unusual.
Hmm.
That um, I think that's actually the first time that's ever happened, where bonds were down that much in coordination with stocks. And in that time period, you didn't get a diversification benefit by holding both of those together. But now, from this point going forward, if you look at where we are now in 2023, well, bonds have re-rated, and it was very painful to get there. But now, on a lot of fixed income, you can get 4, 5, 6% without taking too much risk, too much credit risk. So, bonds are paying interest. Finally, fixed income is paying income. And, we're probably going to see a situation where you do have that diversification benefit where normally in a year where the markets get really, really volatile, the stock market, bonds normally do pretty well, or they at least do relatively to stocks. And that's extremely valuable when you have money that you need to take or withdraw because you're going to pull from the thing that is less undervalued, right? Or is a little bit better. So you can give your undervalued assets time to recover in the market. So that's the argument for putting some fixed income in, you know, but that doesn't necessarily matter for folks who are very, very far from needing withdrawals, right? So I think the idea that Buffett and Munger talk about, where it's, you want to maximize returns and do as best as possible, that makes sense in your accumulation phase. So kind of where you and I are, right? We're very far from necessarily needing to withdraw from our assets on an annual basis. But if you're trying to save for a specific thing, let's say you want to buy a house in the next 3 or 4 years or 5 years, you probably shouldn't put those dollars into very volatile stocks, because you need to be confident that at the point where you need that money in a few years from now, that value is going to be there, and we could be in a position where the market's down 30% at that time.
Yeah. Well, or if you are going to try to save up for a house, that you allocate it in a very certain kind of way. Like, let's say, you have specific accounts for retirement, like a Roth IRA or 401k, even though you could take a loan out against your 401k, right? But should you really kind of like rob from your future self to get a
Mhm.
thing now? So in some ways, I mean, again, this is not advice to people, but for myself, if I'm allocating toward retirement, I do not touch any of those funds. So sometimes I think I can allow myself to have more volatility in, say, a Roth IRA, because I know that that's going to try to grow for the next 60, 70 years. Whereas if I was saving for a house, you might want to keep that in something that is more accessible, that you can use, like a high yield savings account, some of which are offering upwards of almost 5%, and some a little bit more, but they usually come with catches. So, you can, if you kind of need liquid money soon, like, I think this is a great time for savers who like saving money. And I think the more that we can be financially prudent in this time where it's feeling like kind of uncertain out there, like, it's not to say that we shouldn't invest, but we should kind of like be mindful of kind of like potential opportunities that are around. Because even Buffett, I think he seems to be hedging a little bit based on the fact that like 130 billion or so is in cash. And
Hmm.
that, when I say in cash, it's in like these treasuries that are fairly liquid, even for Berkshire Hathaway. And so if you think about their market cap being, I think, around 730 or 750 billion, like, that's 20% that's not being specifically allocated to equities or buying whole companies or stakes in companies. They're kind of keeping that as ready dry powder. So it kind of makes me wonder, if Buffett is sort of, trying to keep some money for a rainy day, maybe that's potentially a good strategy for some, but may not work for everybody, depending on, one's cash flow needs, right?
Yeah, definitely. And I think, well, in a way, Buffett is doing what we're talking about, where they run an insurance company, right? An insurance company, you get the float, but there is a deferred liability within that float of they will have to pay out claims, and they don't know what that claim amount is going to be. So think about having an expense coming up, and you don't even know what that dollar amount is going to be or when it's going to come. So they always, and they've mentioned this before, they're going to keep a significant amount of cash on the balance sheet, even if they want to invest or it's the most favorable time to put money in the market. They're going to keep tens of billions at least, right? Because they know that they might have those withdrawal needs for paying out claims and things like that. So it's just the same concept in a different way. I also do agree with you that, well, they're going to have this. They're going to have this cash hoard that they need for the insurance business, but they have cash and well in excess of that, right? So it seems like they're waiting for some type of opportunity or seeing something in the market that's attractive that they haven't yet seen. I think having a cash set aside is definitely important, but you don't want to go too crazy with it, because at the end of the day, not everybody is Buffett. Not everybody's Buffett, not everybody's Munger. You want to make sure you don't wait too long and miss out on, just the growth in the US economy, the growth in the stock market, because, I've seen situations where, I mean, we have clients where they got out of the market in '07, actually close to the top, and they actually never fully got back in, because they always were looking over their shoulder and looking around the corner and saying, well, it could drop again, because things never looked really great. And they missed out on the snapback, right? And it went past break even and up to new highs. And they eventually, some people got in back later than that, but they missed out on possible returns. So I think it's a balancing act, and there's is a balance between those two things.
Yeah, for sure. So, I mean, it kind of makes sense as to why Buffett advocates for ideally being as invested as possible. Like
Mm,
he doesn't seem to like holding on to the cash, even though like if they only need 30 billion to afford some of those insurance claim payouts, and yet the excess is like 100 billion. So, they're collecting a decent return on it for the time being of like 5 to 6% in from the treasuries, which is not half bad, right? Like if you kind of think about it, the stock market's historical return over the last 200 years was around 6.7% or around 7%. Like it's not so far off from what you'd be kind of getting from the stock market. But we may not have fixed income at these elevated interest rates forever, right? So it's kind of like an okay thing to take advantage of if you're in that position. But the best game in town, I think, and I think Buffett would probably also say this, has always been in American business. Like if you can either be your own business owner or invest in companies and stocks, that's kind of the better way to go than to rely on things that are probably more inherently debt instruments, which bonds kind of are.
Yeah, with fixed income, you always have this inflation risk, right? Where if inflation is higher than the market expects, you could actually have a negative real return on your bonds, right? So bonds get killed in an inflationary environment where inflation is higher than the market expects. That's the key point. Um, Whereas stocks, they don't hedge inflation perfectly, but they have a little bit more protection than bonds do. Whereas if inflation surprises to the upside, companies can raise their prices along with inflation, right? So stocks might not do well in an inflationary environment, but if the inflationary environment lasts a longer period of time, stocks are poised to do better than bonds because the bond return is fixed based on what the coupon is at which you bought it. Um, One thing I did want to just follow up on and point out too, his advice to put money into index funds, he really only talks about one index fund, which is the S&P 500 index. And the S&P 500 index has done really well. Looking, if you go the past 100 years almost, it's returned about 10% annually throughout the entire history. Um, but I think there's also risk with just putting everything in the S&P 500 because it doesn't happen often, but there have been periods where the S&P has performed poorly on absolute terms over a 10-year period. So, for example, one example would be the lost decade, which was from the year 2000 to 2010. You really experienced both stock market drops within that 10-year period, so the dot-com bubble and also the 09 financial crisis. And for that 10-year period, if you're investing on the S&P, you actually had a negative return over that 10-year period because you experienced both of those crashes. Whereas if you had exposure to the S&P, but also exposure to European stocks, some emerging market stocks, real estate, et cetera, you did better by having those other pieces in the portfolio than just only concentrating on the S&P 500. So I think there's an argument to adding in some other diversifying asset classes as well.
Yeah, for sure. And you talk about lost decade, and there was even a period during the Great Depression that it didn't exceed its prior peak for about 25 years, which can we imagine, us being younger people and kind of the stock market like going down some amount and then, hardly making its way back up to the prior peak for 25 years. That's like kind of losing a generation of investors. And it's kind of no wonder, like I've heard people talk about their grandparents kind of like getting burned by the market back in those days. And then they like stopped investing because,
Mhm.
they just felt it was so hopeless. So, I mean, I hope we wouldn't go through that kind of period again of like requiring more than a decade to come back. But it definitely kind of makes you wonder, a lot of people were starved for yield, right? Like
Mhm.
during the pandemic, especially, it's kind of like there was not many places that people could go. Like real estate was being bid up with the low interest rates for a while, and then like some of that may have kind of cooled down a little bit. And in many ways, like even though the market came down a little bit, like say the all-time peak for the S&P 500 was 4,800, being back now at about 4,300, it's really not down by all that much in relative terms. So in some ways, like people should feel comforted that, they haven't probably lost too much if they've been sticking with the index fund and not selling preemptively. So kind of like goes to show that, like to Buffett's point, he advocates for believing in America's future. So if you believe in America's future, he thinks it's a pretty decent bet to invest in the S&P 500, especially if you don't want to take the time yourself to study individual companies and keep tabs on them, which it's not everybody's favorite pastime. Other people might enjoy doing other things.
Definitely, definitely. Yeah, I agree with you on that. Yeah, this is the S&P 500 is a great proxy for the American economy. And even if it goes through periods of negative performance, like we talked about the lost decade, over the very, very long term, as long as the U.S. economy continues to grow, you're likely to have a good result, right? So investing in index funds, especially the S&P, I think is a really good strategy. You did mention something before about IRAs and Roth IRAs and things like that. For folks at different points in their lives, like how are people making these decisions on whether to do the pre-tax 401k or the Roth 401k or the pre-tax IRA, the Roth? Like, how are people making these decisions? It really depends on what your tax rate is now compared to what you think it's going to be in the future, right? If you're in a lower tax rate now, you might want to pay the tax now and have the tax-free growth from the Roth. But if let's say you're in a higher tax rate now and you think you're going to be a lower tax rate in the future, then maybe it makes sense to get the deduction. But all of that is dependent on your own personal financial situation. So like I think the value that you can have from having a financial professional is they're going to take you through that process of figuring that out, right? Because it's hard to figure that out on your own. And that's actually really completely separate from the investment discussion, right? It factors into it because it's about what are you keeping out of your returns, but like that's independent of what stock is the best versus what stocks would be the better investment in a year, right? So the tax planning, all that stuff is really, really important, and also estate planning, et cetera.
Yeah, which I think we should definitely get into talking about estate planning in a future video. I think it's a topic full of so many rich questions that I'm sure some people who want to get ahead in their retirement, ideation might be thinking about, because I mean, sometimes it doesn't seem like enough young people are interested in thinking about these things, or they just want to live for the day, right? But the more that we can set ourselves up now, the way better we'll be when it is actually time for retirement. So I think like you make really great points about considering a lot of those factors.
Definitely, definitely.
And I want to say thank you so much, Will, for talking with me today about juxtaposing some of the things that Warren Buffett and Charlie Munger say with kind of the reality of what people's situations might be. And, knowing that they set a certain standard, which may or may not be realistic for some people's portfolios and financial situations. So, it's great if we could, achieve similar outcomes as the greats have kind of educated us on, and it gives us definitely some great food for thought. But we also shouldn't be too hard on ourselves. Like, I think that's also important, because people think like, yeah, I'm going to get 20% from the stock market every year. And they might not realize that 20% is really hard. Like, only some of the best investors in the world can consistently perform at that. So we shouldn't just think like we're going to kill it every year. We should, try to be humble and try to like, set ourselves up and kind of protect, what we're trying to build as a financial nest egg, whether it's, for our own retirements or for our families and other goals and objectives we have, right? So with that, did you have any closing thoughts you wanted to share?
Yeah, definitely. Just on that, so getting 20% a year, that's the top tenth of 1% of all investors, really, over the long term. So you shouldn't be too hard on yourself if you don't get that. And it's okay if you're not Buffett or you're not Munger to diversify a little bit, right? So you don't have to have your all your money in the top 5 positions. If you just don't want to spend the time doing all the work to really get that level of confidence, right? Like, you can diversify a little bit. You can have more than that and still have a good result. So I think it's all about tailoring the wisdom that we've gotten from Buffett and Munger to our personal financial situation, not necessarily holding ourselves to that standard of being the best in the very world, right? There's something in between, in the middle.
Yeah, for sure. And I think hopefully that helps people in the audience. And we thank you so much for joining in and listening. And thank you again, Will. Appreciate it.
Yeah. Thanks to the audience. Thanks for having me, Michelle.
All right. Bye-bye.